So instead of one time period of the stock market, let's look at the last 16 15-year time periods in the stock market since 1996. And everyone always tells you, oh, you better plan on a 12% rate of return in the stock market. We think that's crazy to plan for. In certain years, you'll get 12% or higher, but to average 12% is going to be very difficult. Why? Well, if they tell you you're going to get 12% that we call an urban legend, these are the average annual increases to the S&P 500 for every 15-year time period. So 96 to 2010, it was less than 5% per year. 98 to 2012, it was less than 3%. 2003 to 2017, because you were past the bubble of the technology, it was a little bit less than 8. It never hit 12. It got really close over here because that was after the 2001 and 2 technology bubble, and it was after the 2008 financial crisis. So it was basically meaning you invested at the bottom of the market. The average has been 6.09%. So if the average has been 6.09% per year for every one of the 16, 15-year time periods, how in the heck are you ever going to get a 12% gain? And if you're planning to get a 12% or a 10% or an 8% gain, and you only get 6%, what's going to happen to your plan? It's going to blow up. We're never going to plan for more than a 4% rate of return when you have money in the stock market, because isn't that closer to the worst case scenario as an average? 4% means our plans will not blow up. So at retirement, you have to plan for a worst case scenario. Before retirement, you can plan on best case. Try to get the highest rates of return regardless of the risk. At retirement, can you plan for the best case and then the best case not happen? You can't. You have a high probability it's going to fail then.